You know, when your spouse dies, the IRS does not send a condolence card. In fact, it sends a larger tax bill. Happens all the time. You see, the very next year on less income, the surviving spouse routinely pays thousands of dollars or more in tax. And it's not because they did anything wrong. It's because the tax code stops treating them like a married couple and starts treating them like a single individual. And almost no one sees it coming until the bill lands in the mailbox. Take, for example, Dave and Lisa. You see, they were married for 44 years. They paid off their house. They did everything right. Dave handled the money, always had. He passed away at 71. And the next April, Lisa got a tax bill bigger than when Dave was alive, while she's living on less. She didn't earn more. She didn't sell a thing. And here's the good news. The whole reason I'm making this video is every dollar of what happened to Lisa was preventable, but only while both spouses are still alive. So I'm going to do something most of these videos won't. And I'm going to show you the 5 problems that ambush the surviving spouse and give you the actual fix for each one with real numbers. So stay to the end because I'm going to add it all up, what all 5 cost this ordinary couple, and it's a number that'll make you want to call your attorney first thing in the morning. Okay, so first let me kill the myth that probably put this video into your feed. Transfer these assets before your spouse dies or the IRS takes 50%. Listen, I'm an attorney and I don't get paid to scare you, so here's the truth. For almost everyone watching, the federal estate tax is 0, okay? That's it, it's 0. Right now, okay, the way it works for 2026, each of you can pass on $15 million. That's $30 million as a couple. So if you're thinking about federal estate tax and you're going to have to pay that, that's not what I'm getting after. That's going to be 0 for the vast majority of people. Okay? See, David and Lisa weren't within a country mile of $30 million. Their federal estate tax was 0. The danger was never the IRS. It was 5 quieter things that land squarely on the survivor that you may not even be aware of. So I'm going to walk you through all 5 as I stated in the fix for each. Okay, so here's the first problem. We refer to this as the widow's penalty. Okay, so what is it? The rule is simple. The year your spouse dies, you can still file jointly. After that, unless you've got a dependent child at home, you file as a single individual. So watch what that does to the exact same income when we're in this situation. I'm going to whiteboard all this out for you. Okay, so what I'm going to do is I'm just going to break it down and show you. So let's say we have $130,000 of income. All right, now, when you're married, we're going to put a column here for the married, and then we'll put it for single because that's what you switch over to. So when you have a standard deduction, we'll just call that standard D. When you're married, it's $30K. When you're single, that's going to put you at $15,000. So if you take your standard deduction, that leaves your taxable income. This is where the numbers start to hit right here at $100,000 because you take your income less your deduction. That leaves you at $100,000 of taxable income. Now over on this side, when you're single, it's going to be $115,000 because you only have half the deduction. So our federal tax now on this, if we carry this through, it's going to be on the married side about $11,800, whereas on the single side now, because you're in a higher tax bracket, because you're single, you're no longer considered married, it's $20,400 of taxes. Okay, so when you look at this, all right, that right there is an extra $8,600 a year in tax. Now you have to add on to this, okay? So this is going to be your IRMA, your Medicare surcharge. That's another $1,000, okay, on top of that. So you add those together, this turns out to be, with the difference in the taxes here, so the taxes was $8,600 difference. So you add that up, now you're at $9,600. Over 10 years, look where we're at. Okay, we're over $90,000 more in taxes over 10 years. So that's quite a bit of money. Now here's the fix you can actually use, all right? You can't repeal this penalty here, but you can shrink what it bites. In the years you're both alive, you can do this. You deliberately use that wider joint married tax bracket to take in more of your income, meaning if you've got an IRA or a Roth, let's assume that here they are, they have two retirement accounts. They had a traditional IRA and they had a Roth IRA. Now, as you know, the Roth IRA, right, that money is tax-free when you pull it out, where a traditional IRA is taxable. So when you're considering doing things, I would be withdrawing from your traditional IRA now and leave the Roth for later. So the surviving spouse can take those funds out at the single rate rather than pulling out the taxable. This is all taxable here. Taxable now when you first spouse passes at the higher rate. So that's one thing to consider with your IRAs and retirement accounts. Or if you're going to do a rollover, a conversion that is, converting from a traditional to a Roth, make those conversions earlier when you have those wider tax brackets to take advantage of. So then your survivor then has a lower tax bracket or more compressed tax bracket. They won't have as much taxable income. So in gap years, you want to be drawing from your traditional IRAs or making the conversions in those future years, because that's all going to work out in the survivor's favor. Okay, so the second problem is, problem number 2, that is what the clickbait circles and gets half right. It's called step up in basis when your spouse dies. Certain assets reset their cost basis to the date of death value, wiping out the built-in gain. But the catch is all about your state, So if you're not familiar with step up in basis it means if you bought an asset and you paid $100,000 for it, then when the first spouse passes, the value of that asset will be stepped up to whatever its current value is or a portion thereof. Now, I've got a video on this when it comes to real estate that you're definitely going to check out on my channel. But the thing that people do not understand is this can have a material impact on your taxes later on if the survivor needs to sell assets. States such as Washington, California, Texas, what we call community property states, the whole value of the asset is stepped up. So if I had a house here, we bought this house in 2001 for $400,000. And then the first spouse, assuming this is a community property state, say Washington State, the couple, first spouse passes away and that house is now worth $1 million. Well, the surviving spouse, when you ask what is her basis in that home, it's stepped up to the full $1 million. That means she could sell it the next day for $1 million and she'd have zero capital gains. Whereas if you don't live in a community property state, maybe it's a separate property state such as Oregon. So when the first spouse passes away, the way it works there is they say, so when the spouse takes it, if it's valued at $1 million, the basis will only go up for half. So you say it's $400, $1 million, that's $600,000. They take half of that, $300,000. So that puts the surviving spouse with a $700,000 tax basis. So if she was to sell that property the next day, she would have $300,000 in gain that she would be able then to use her capital gains exclusion under 121 at 250, which would leave her with $50,000 of taxable gain. You see, depending on where you live, it could be either be a taxable gain or it could be no gain at all because of the basis step-up rules. So that's what you're looking at there, understanding how this works. Now, this doesn't only just apply to real estate. A brokerage account, same thing. Say the brokerage account is worth $80,000, right? $80,000, all right? It gets stepped up to whatever the full value of the brokerage account is. So I said worth $80,000. I meant its basis is $80,000. So that's what you look at. You take every asset you have, and it's going to be stepped up either half or it's going to be stepped up to 100%. Now, there's a fix. There's a tool called a community property trust offered in a handful of states like Alaska, Tennessee, and South Dakota that lets a couple in a separate property state convert their assets to community property and capture the full 100% step up. So it's the same account. However, it's held in a special type of trust. Therefore, you have zero capital gains tax. And so what you need to do there is look at putting your most appreciated assets into this trust. You move them in, and then when the first spouse passes, the survivor gets a full step up in basis when they later sell those assets. So it's a powerful tool, okay, that you ought to consider. Now, the third problem is going to be what we call the retirement account trap. And what this problem does, it catches the people who think that the step up saves everything. See, your traditional IRA and your 401k, those don't get any step up, okay? They get none. Every dollar that comes out as ordinary income. And now, as I kind of hinted at this earlier, we did the first example, the survivor's pulling all these in at those compressed single tax rates. So the account that Dave was most proud of does the most damage. All right, so this is a real issue here with IRAs, as I talked about, that all that gets converted and rolled over to the surviving spouse. Then they have to claim all that in income as they start drawing it down in their higher tax brackets. So what you want to do is, like I talked about, is you want to start spending that earlier, spending it down. So any taxable accounts, while you're both alive and you're married, you should be hitting that taxable income sooner rather than later. Save the tax-free stuff for the survivor, or do the conversions like I talked about. Those can be highly beneficial as well. The fourth problem, it's called probate. And of course, this is also an unfunded plan. It's where a lot of people think, oh, I've got this handled. I have a will. I even got a trust. Here's a rule that surprises them. A will does not avoid probate. A will is your ticket into it. And a living trust only works if your assets are actually inside of it. Now, I also told you earlier about the estate tax. Okay? The problem is that for many people is that they live in a state that has a death tax or an estate tax that is much smaller than the federal estate tax. So you may not have to pay the feds any money, but you have to pay your state money. So you want to ensure that you're avoiding probate, okay? Because let's say on a $1.2 million estate, in some states, that probate might run you $60,000 to $100,000 in costs. All right, and take up to 24 months. And then on top of that, that state may have an estate tax that you have to pay in addition to that. So you may have all your step up in basis. You may have done everything else right with the income side, as we've been talking about. But the issue you're going to run into is that your estate is going to be subject to estate taxation. So what do we do there? Well, then in that case, what you got to be looking at is setting up, of course, you got to have a living trust. You have to have it fully funded. And then you want to make sure you have the right types of provisions inside of that trust to make sure we're capturing each spouse's estate tax exemption. And so a lot of times what we'll do in those scenarios is we create a living trust. So here's your estate right here. It's all held inside this living trust. And then when the first spouse passes away, we want to know what their exemption is. If they don't have portability, meaning you can run it to or roll it over the surviving spouse. And so for example purposes, let's assume that each person could pass on $2 million free of state estate tax. If they have portability, that means that when the first spouse passes, you can roll that $2 million over to the survivor, and then the survivor gets a total of $4 million. Well, if that's not in your law, then what occurs is that in most living trust, when the first spouse passes away, everything goes to the survivor. So the survivor sits on the trust with $4 million. Well, when the survivor passes, then since she can only pass on $2 million free of estate tax, then you take off her exemption amount, then the state's going to say, hey, you owe us tax on $2 million. Now, this is a really simple fix with a living trust. And the way you do it is you ensure that when the first spouse passes away, you take the assets and they divide. So you allocate $2 million to the decedent right here, so that passes free of estate tax. And then you take the remaining portion for the surviving spouse right here, okay, because she's still alive, and you give her $2 million. Now, if she passed away tomorrow because she's heartbroken that she lost her husband, hopefully that's going to happen, right, when I go. Well, no, maybe not. I mean, we'll be together. then this would pass free of estate tax as well. So we just passed $4 million on free of any state estate tax by separating the assets and taking advantage of each individual's exemption in this manner. Now, this was a simple example of $4 million. Let's assume this couple had an estate valued at $5.5 million. Well, what do we do there? Then you can create a third trust here called a Q-tip trust. And you put $1.5 million in this trust. And the way this is structured is you have the wife spend all this money down while she's alive and leave the other $4 million sitting off to the side. So the point in me sharing all this with you is that there's tools to do this, to solve this problem. Okay, one is to solve probate and the other is to solve the state death tax. So I really gave you two problems all in one with this one. Probate and the state death tax is what costs people money after the first spouse passes. Not to mention, what I find a lot of times is that when the first spouse passes away, if you don't have a living trust set up, this is where probate can get really expensive, so I'm kind of backtracking here, is you have a house that it's in both of your names, like this, and then the first spouse passes, then the survivor just keeps living there and nothing happens with this property, then the survivor passes and they leave this asset to their kids like this. Now it becomes a real problem because the title is held in mom and dad's name and they're both gone. So now you've clouded title on that property. And so in order for the kids to gain title to the property, then they have to open up some probates and it gets really expensive at that point in time. That is, again, why you would want to use a living trust. Again, to keep these taxes down and expenses after the first spouse has passed away. So if you've been watching this video right now and you're saying, hey, there's 5 preventable things that I could avoid here if I do it the right way, it's true. You just have to sit down with somebody who understands this and help you draw out the right plan and analyze your situation from top to bottom. And it's a really easy fix. And many people don't even realize how easy it is until they actually sit down with someone who breaks it down like I've been doing here in this video and shows you if you do these few simple steps, you're going to put more money in your survivor's pocket, which ultimately means those funds, if handled properly, then will pass on to your beneficiaries. Guys, if you liked the video, be sure to hit the like button. And I wish you the very best with your planning.